By the end of this video, you'll see just how much value you're losing because of Wall Street's greed and how to fix it. This video applies even if you think you're getting free trades. When you submit an order today, it goes to your broker, to an internalization agent, to a routing agent, to an exchange, to a market maker, to a clearing agent, to a depository agent, to a settling bank, to another broker. But it doesn't need to be this way. To fully understand, we need to go back in time. 1602. A Dutch trading company issues the first modern stock. Investors can transfer shares with the company bookkeeper, but there's a problem that's persisted for centuries. Investors have to physically travel to the company office, pay about $200, and wait for two board directors to sign off on an official book entry transfer. Almost immediately, investors trade the first stock futures to avoid these costs. But these futures carry immense credit risk. An investor that lost money could flee Amsterdam to avoid payments. Moreover, courts often declared contract losses null and void based on a short selling ban. To avoid defaults, investors stopped trading with the average uncreditworthy man. Instead, most people were forced to pay established, credible brokers to execute their trades. Fast forward hundreds of years and we all still rely on brokers. But these institutions are controlled by shareholders aiming to maximize profits. In other words, they have a direct conflict of interest with your investment returns. Say you want to buy a stock for $10. 1 in 10 times another investor at your broker or your broker itself is selling the same stock for $9.97. So the broker matches both orders and pockets the 3-cent difference. But if your order can't be filled internally, it gets sent to an order router. The order routing company has trusted access to stock exchanges and dozens of separate marketplace companies. On a normal exchange, everyone can see the trading history, but everyday investors can't see activity from most marketplace companies. To attract orders, marketplace companies pay routers a cash rebate versus the high fees charged by exchanges. High-frequency trading companies fund these rebates while making billions capturing micro-penny differences between marketplace companies. In our example, a high-frequency trader might buy your order flow for 28 hundredths of a cent, buy shares at $9.97 from a different hidden marketplace company, and sell them back to you at $10.04. From all this, the order routing company might get paid 23 hundredths of a cent, of which they pass on 0.2 of a cent to your broker. In total, you lost 4 cents versus the quote you saw on your screen, while 4 middlemen made over 6 cents. This is possible and legal as long as prices fall within exchange quotes, but marketplace companies widen official spreads and increase overall volatility by taking price-moving volume away from exchanges. Then a separate clearing company receives the match trade. At the end of the day, the clearing company combines your order with any other. Say investors from your broker bought 1 million shares overall and sold 990,000. The clearing company finds which broker sold your broker shares and makes a bulk transfer for the excess 10,000. To pay for these shares, your broker's balance gets forwarded to a separate depository record. Then the depository company sends a fund debit to a separate settling bank. Finally, your broker pays the settling bank, which pays the depository, which pays into the settlement system, which credits the other broker to cancel out the clearing debt. Your broker pays fees for this, which will be problematic without the next innovation. As you likely know, your broker earns interest on extra cash in your account. But did you know they also loan out shares you buy and hold? Thanks to the clearing and depository companies, brokers can quite easily offer up all your stocks for loan to other brokers. When a hedge fund wants to short a stock, they can borrow your shares, sell them at the market, and wait for the stock to fall. Later, they buy back shares and deliver them to your broker, plus 5 to 20% annual interest in cash, all hidden from you. These loans create a major source of broker income, but they create huge problems. First off, the depository company pays dividends to the stock borrower, who in turn pays you cash in lieu of dividends, which get taxed as ordinary income instead of qualified dividends on your 1099. Furthermore, brokers can lend out shares they don't actually have, and the clearing system just lets them. There are full-time engineers at the clearing monopoly that spend all day asking brokers nicely to deliver shares they sold. But on the other end of the trade, the borrower enters a short position by selling the fake shares they received, none the wiser. This creates a new investor who the depository monopoly says owns shares, even though those shares don't actually exist on a company's capital book. By allowing investors to sell tens of billions of shares per year that don't exist, the modern clearing system devalues all listed securities. For instance, Dole Foods went private in 2013 for $1.2 billion. The company only had 37 million shares outstanding, but brokerage investors held 49 million shares. Similarly, 2 investors simultaneously bought 1.5 million Global Link shares through their brokers, despite the company issuing under 1.2 million shares, leading to huge legal headaches and investor losses. More recently, 1 in 20 GameStop shares traded did not exist on the company's capital books. In another case, a fifth of Overstock.com shares trading did not truly exist. The problem is so big that the leading transfer agent organization suspects more shares voted than exist in over 3/4 of annual meetings. In an election at Taser International, brokerage investors cast 82 million votes despite only 61 million shares existing. How can shares reach their full market value with invisible sellers pushing them down? Why don't we just use companies' direct capital books for investor records? It all comes down to the same problem the Dutch traders faced. Nowadays, public companies have a transfer agent that acts as a corporate secretary, keeping a list of all registered investors. But the only way to get on this list is through a direct share purchase plan, employee stock options, or expensive direct registration from your broker. Moreover, it's useless to hold book entry stock because 400 years later, it's still incredibly challenging to transfer shares. If you want to transfer stock at any traditional transfer agent, you have to print and fill out a bunch of complicated paperwork, go to the bank with 2 valid IDs, wait for the bank to sign and stamp everything, and snail mail the forms just to wait weeks for a response. If you live outside of the US or far from an authorizing bank, you're stuck paying hundreds of dollars for the special bank stamp. But what if it didn't have to be this way? A year ago, we submitted a utility patent to use modern cryptography in place of these special stamps. Since then, we've registered as a transfer agent with the SEC, and we're now accepting our first public companies to put their stock on the blockchain so that investors can trade directly with each other. This is possible because our clients use a decade-tested blockchain directly as their capital books. These trades execute with zero middlemen or fees using math, and shares settle instantly at a cost to us of hundredths of a penny. Since issuers maintain shareholder records below central clearinghouses, you know for certain that the shares on the blockchain belong exclusively to you. And unlike opaque aspects of traditional stock markets, all share transfer and management data stays on the public blockchain. This is the future of capital markets. Join us by downloading our investor app and access our waitlist to invest in our clients' shares with transfers insured against error by Berkshire Hathaway. The most important part of this new idea is swift adoption by stock issuers. You can only invest directly with blockchain if the underlying company uses us as their transfer agent, so share this information with them.